All right, joining us right now on the broader markets is Stephanie Link, Hightower chief investment strategist and portfolio manager, also a CNBC contributor. And Stephanie, we did see a down week for the S&P and the NASDAQ last week, but we also got some pretty decent economic data towards the end of the week.
Yeah, I feel like I come on every week and the numbers keep ratcheting higher in terms of GDP. I mean, right now, the Atlanta Fed tracker is running at about 3.9% for the third quarter, and that follows the 3.8% we saw for the second quarter last week. And the data, Becky, is just, it's good. It's strong. Weekly claims came down. That was really important last week to 218,000. That had been kind of creeping higher. And so that's the number I watch for the labor market. And I smooth it out looking at the 4-week moving average. And you're running at about 230,000 per week, which is very healthy. It's ratcheting higher, as I mentioned, but it's still very healthy. Durable goods, thanks to Boeing, rose 5.4% last week, year over year. Personal income, personal spending, those numbers continue to be really quite solid. And even new home sales, which was kind of surprising, rose 20% month over month and is up 15% year over year. We're growing in like the 3% range, and we haven't even had a housing cycle yet. So just imagine when we do, because there's such a multiplier effect. So with lower rates, that should eventually happen. So good numbers. Maybe October is always a weird month, but maybe we have a little bit of a sideways action in the short term. But I do think that the earnings picture for the next quarter is going to be very good, and 4Q overall sets up pretty well.
You sound a lot like a note I was just reading from Ed Yardeni. We have him on pretty frequently, too. And he's talking about how, his thesis that this is the roaring 20s has proved true since 2020. Looks like good times ahead. What do you do as an investor in that environment?
Good times ahead. Well, Ed and I used to work together, so I'm not surprised that actually we have the same kind of thinking here. Look, I think the numbers are going to be good. Earnings are the most important tell for the markets, and I think it's going to be pretty broad-based. We've been talking about the broadening out in the markets, and I think you want to own things beyond tech. I do own tech, but things beyond tech. As I mentioned, housing, I think, sets up very well. Autos. If we get lower interest rates, I think the auto market will start to see a recovery. And those are two lagging areas in the market overall. Financials are going to do very well. In fact, Morgan Stanley this morning raised targets across the spectrum of the names, the large cap banks, because the numbers are going to be very good. And those stocks are still quite cheap. And I think, the industrial play and the data center stuff that we've been talking about for 3 years, I think that continues to do very well. And the visibility is very good.
You like Capital One in particular, I think?
Yeah, well, I recently bought this about a month ago, and I do like it. The stock is very cheap at 14 times forward estimates. But the reason I bought it is because they just closed the Discover Financial acquisition in July, and I think it's a game changer in terms of them now having a scalable payments network, one of only two in the U.S. American Express is the other one. And American Express trades at 20 times forward estimates. But I think the synergies will be substantial. I think the earnings power of something like $26 a share is very doable. And they have excess capital, so they can return it to shareholders as well.
Okay, let's talk some of the tech names that you like. CrowdStrike and Palo Alto Networks. Why those two?
Yeah, well, I think cybersecurity is certainly something that we're in very early innings, something like the second innings or third innings. And I think a lot of it is because it's driven by AI. I mean, AI really is not safe at this moment in time, so you need more cybersecurity. I think you're going to see consolidation overall in the sector. We have 4,000 cybersecurity companies in the world, public and private, and I think you're going to see massive consolidation because, quite frankly, companies don't want to have 20 to 30 different vendors. And even the biggest companies like CrowdStrike, like Palo Alto, they don't offer one-stop shop. They don't have everything for their customers. So they're going to continue to acquire the technologies. CrowdStrike trades at an expensive multiple, but they just raised guidance 2 weeks ago. So it's trading at about 27 times price to sales. Again, not cheap, but Palo Alto is cheaper at 14 times. And so I think you can own a basket of these names.
Steph, you point out another tailwind for the markets, and that is with the Fed lowering rates. you're not getting as much money in the money markets as you were last year. And that's probably an important point for people to think about.
I mean, I think so. I mean, we for years we had, you could get nothing in money markets, right? And then the last couple of years with the Fed raising rates, you could get almost 5% plus. And so with the Fed lowering interest rates, I do think you're going to see some of the money come off the sidelines. I know it's something like $7.5, $8 trillion of money in money markets right now. I don't think it's all going to come, Becky, but I do think it is a nice tailwind for investors looking for more opportunities, better yielding results as rates come down.
So what's the one headwind, one thing that concerns you that could come out of left field? What's one thing you kind of watch for that thinks, okay, all of these great tailwinds, all of these things that are setting us up, unless X?
Yeah, no, I mean, honestly, the thing I watch the most is the labor market. And I know there's a lot of ways you can. ADP, non-farm payrolls. You can look at some of the PMIs and some of the surveys. I look at the weekly claims because it's more of a leading indicator or a coincident indicator. Excuse me. And those numbers, as I mentioned earlier, they are a little bit higher than they were a year ago. A year ago, we were running at about 200,000 weekly jobless claims. So I watch it. The number, if it gets to something like 250, 260 per week, that's when the yellow flag goes higher. Recessions are normally that number, the weekly jobless claims, gets to something like 350 to 375,000. But it's going to be too late once we get there, if we get there, to be worried. So I'm just watching the trajectory of weekly jobless claims because we know that the consumer, if they have a job and they have wage growth, and as I mentioned earlier, wages are growing at about 5%. If they have a job and they have wage growth, inflation is sticky, but it's coming down, but the consumer continues to spend. Once the labor market softens, that changes the whole thing. So that's what I watch very, very closely. Feel good about it, though, right now.
You didn't mention anything at all about the government shutdown. Is that because you don't think it's going to happen? You don't think it will lead to the job cuts that the administration has threatened if the Democrats don't go along with the Republican bill on this?
I think they will. In the 11th hour, in the middle of the night, they'll get something done. They'll probably kick the can. This is what they do. They kick the can all the time. So I don't worry. And if there is an issue with regards to a shutdown, A, I think it'll be short-lived, and B, I think it's your opportunity. Again, October is a kind of a rough month, right? The first half of October is usually kind of weak. The second half is a little bit better. So you take advantage of that because, again, at the end of the day, it really is about earnings. And with the economy growing, even if the economy slows to 2.5%, which we're not there, we're at 3.9% at this moment in time. Sure. Even if we do slow, I think the earnings picture will still be good.